welcome back guys. And pasensya na kung nawawala ang boses. Ito ay natural resource din. So we will be discussing natural resources. So we will be talking about depletion. So when we talk about depletion, we are referring to the allocation of the cost of a wasting asset over its estimated useful life, which is normally its life is expressed in the expected output from that wasting asset project or natural resource. So by definition, wasting assets are called natural resources. So they are material objects of economic value and utility to man produced by nature. So it's produced by nature. So this includes coal, oil, or precious metals like gold and silver, as well as timber. So by its definition, it's physically consumed materials of economic value, and it's from the nature, so it's irreplaceable. Wasting assets have several cost categories. We have acquisition, exploration, development, estimated restoration. So let's discuss it one by one. Acquisition cost. This is the purchase price. It is the price paid to obtain the property containing the natural resources. It's the initial cost of the wasting asset or the natural resource property. While exploration cost, so it's the expenditure incurred before the technical feasibility and commercial viability of extracting a mineral resource are demonstrated before. So you purchase, then you explore that property. So it is the cost incurred in an attempt to locate the natural resource that can economically be extracted. So after you purchase the property, of course, you will start exploring that property. Then another cost incurred by the company is the development cost. So this time, after you purchase and explore, you will now be able to exploit or extract the natural resources. So that is called the development cost. So development costs have two forms. You have the tangible equipments and the intangible development cost. If it's tangible equipment, we account it separately. If it's intangible, like drillings, wells, it becomes part of the cost of natural resources. So while tangible equipment or tangible assets, which includes transportation equipment, heavy machinery, tunnel bunkers, and mine shaft that you can see in your screen, they are not capitalized as part of the natural resources, but capitalized as a separate account, particularly PPE, property, plant, and equipment, and of course, depreciated in accordance with the normal depreciation policies. If you are new to this channel, please refer to my previous videos on depreciation. I have discussed depreciation in 3 parts there, so please check out my discussions on depreciation. Okay. Then another cost is the restoration. Of course, after you exploited the natural resources, you will be required to bring back the property to its original condition, especially if it's required by law. And that estimated restoration cost is shown also as discounted amount. Or tangible assets, the term used is depreciation. While if we are allocating the cost of natural resources, the method is called depletion. So normally, the method used for depletion is output or production method. So let's apply what we have discussed earlier, the terminologies we have discussed earlier. So as you can see in our screen here, again, my advice for you students is to pause this video for a while, get your pen, paper, and calculator, and start computing, and do your work first before going back to this video to check if your answers are correct, to verify if your answers are correct. I assume you have already done your part, so let's read again the problem. At the beginning of the year, Virus Company purchased a mineral mine for 25 million with removable ore estimated at 1,500,000. Okay, let's do. Let's go straight to our solution. I'm going straight into the solution because I'm highlighting important details from the problem itself, so I don't have to read the entire problem again. Okay. Colored blue is the purchase price for 25 million. Then we have, remember in our previous discussion that restoration cost must be translated into its present value. So although it was given that the estimated cost is 2.5, it's also given the problem that the restoration cost here is 2 million. Okay. Then we have also 3 million given also in the problem, 3 million development cost. Okay. So again, you have purchase price, 25 million, restoration cost, 2 million, development cost, 3 million. So acquisition cost 25 plus development cost of 3 million plus estimated restoration cost, which is 2 million. So your total cost is 30 million. Going back to our problem, it says here, the entity will be able to sell the property afterwards for 3 million. So the same with our depreciation computation, scrap value are not included as part of depreciable cost. So the same with depletion, residual value are deducted from the total cost to get the depletable amount, or its equivalent in PPA, the depreciable amount. Okay, so now our total depletable amount is 25 million. Then our expected output here to be extracted is 1.5 million. Therefore, our depletion rate is 18 per unit. So for the year, we extracted 90,000 times 18 depletion per unit. So the total depletion for the year is 1,620,000. That's for the total depletion for the year. And the depletion included in our cost of goods sold, which in which we have sold 50,000 units. So 50,000 times 18 is 900,000. So it depends on what is asked in the problem. So I have shown you two possible questions that may arise. Depletion for the year, so total extracted units times the depletion rate per unit, or the problem could ask you how much depletion is included in the cost of goods sold. So we will only include the number of units sold times the depletion rate. Okay, let's proceed. Another sample problem. We have here, Bato Sai company was engaged in rock and gravel business. The following transactions relate to the acquisition and development of an extensive extensive gravel pit. The focus of the problem here is, you have here, from the date of acquisition, then you have added additional development costs to further explore, or to further exploit the natural resources. And another issue here is, aside from additional development costs, there's also a change in the estimate of the remaining output. So from 2019 here, estimated output is 2.5. In 2021, the remaining estimated output becomes 3 million. So let's solve this problem year by year. Let's start with 2019. Okay. In 2019, the cost of the property is 1 million. Our estimated output, we are talking in about 2019. So in 2019, the estimated output is still 2.5 million. So our depletion rate per ton is 40 cents per ton. Okay. So our journal entry for 2019 would include the cost of the property we invested, which is 1 million. So that's rock and gravel property, credit cash for 1 million, and the depletion for the extracted unit, which is 1,000 times 40 cents. So the debit depletion, credit accumulated depletion. That's for 2019, the start of the year. Okay, let's look at again the problem. The following year, the company incurred additional development cost for 500,000 and extracted or produced 500,000 tons. 500,000 pesos additional cost. Units produced 500,000 tons. Okay, so our total cost now is the original 1 million plus the additional development cost of 500,000. So you now have 1,500,000 minus last year's or 2019's accumulated depletion of 400,000. So our net amount is 1,100,000. Okay, divided by the estimated remaining output of 1,500,000. Take note, guys, that there was no change in the estimated output yet in 2020. So in 2019, it was estimated that it's 2.5 million. In 2020, there's no change in the estimate yet. So it's 2.5 original estimate minus the extracted in 2019 of 1 million. So our expected output in 2020 is 1,500,000. So therefore, our new rate per ton in 2020 is 73 cents. So to record what happened in 2020, we will record again the additional costs we incurred, which is 500,000. So debit the wasting asset property or the rock and gravel property, 500,000 credit cash. And we record also the depletion, which is we extracted 500 units, this time at 73 cents. So debit depletion, credit accumulated depletion, which is 500,000 times 0.73. I rounded my computation here at 2 decimal places. So we have 365,000. 2021. Okay. Aside from the additional development cost here, another change happened. The estimated remaining output is now 3 million. Remaining output as of 2021. That means excluding the extracted 1 million in 2019 and 500,000 tons in 2020. And the units produced for 2021 is 800 tons. So let's apply all those changes in 2021. Okay, so our total cost previously 2019, 1 million, 2020, 500,000. So you have 1,500,000. And then additional development cost for 2021 rather, is 1 million, is 800, sorry. Total cost for 2019, 2020, 1,500,000. Additional development cost is 800,000. So total cost to date is 2,300,000. Our total accumulated for depletion is 400 for 2019, 365 for 2020. So that's 765,000. Therefore, our remaining depletable cost is 1,535,000. And this will be allocated over the remaining output of 3 million. Remember the change in 2021? So our new depletion rate is 51 cents per ton. So our entry for 2021 would include, of course, the additional development cost, 800,000 credit cash, and 800,000 extracted units times the depletion rate of 51 cents. So we have 408 depletion for 2021. Let's continue. We have another problem here. Corona Company purchased a tract of resource land in 2019 for 4 million. The content was estimated to be 150 units. And when the resource is exhausted, it is estimated that the land will be worth 100,000. So this is the residual value. So expected output, acquisition price, residual value. This time, we have tangible equipments. We have equipment here as well as a building for 900,000 and 1.5 million. And the building is expected for estimated to have 10 years useful life, and the equipment is 5 years. So let's solve and prepare journal entries for what is happening in 2019 and 2020. Since in 2019, we extracted 20,000 units, and in 2020, 30,000 units. Again, the difference is we have tangible assets here now deployed. Okay, so in 2020, of course, we will record the acquisition costs of 4 million. So resource property, credit cash, 4 million. And we will also record the building and the equipment we purchased, 900 and 1.5 million respectively. So total cash spent is 2.4 million. So for 2019, we have the cost of the property, which is 4 million. Of course, we have to deduct the residual value of 100,000 to get the depletable amount. Then we will have to divide it from our estimated output of 150,000. So we expected 150,000 units. Therefore, our depletion rate is 26 pesos. So therefore, for 2019, remember, we extracted 20,000 units in 2019. So times 26 depletion rate per unit. So you have depletion and accumulated depletion for 520. In 2020, the same thing we will do, 30,000 times 26. Since there are no changes in the estimated output for 2020, so therefore we will still use the depletion rate per unit of 26. So that's 780,000 for 2020. So these are our journal entries to record depletion. But remember, we have tangible assets this time. We have an equipment of 1,500,000 with a useful life of 5 years. An equipment 415 with estimated life of 5 years. So therefore, 1.5 divided by 5 years using the straight line method of depreciation. So it's 300,000 per year. So for 2019, we will record depreciation expense 300,000 and credit accumulated depreciation 300,000 for equipment. Since it's straight line method, we will do the same for 2020. Depreciation and accumulated depreciation equipment for 300,000. That's our journal entry for the depreciation for the equipment. However, in the case of the building's estimated life is 10 years. So we have to watch out for tangible assets that is used in a wasting asset project. In our case here, the building's life is 10 years. The expected units to be extracted for this project is 150,000. In 2019, we extracted 20,000 units. So what happens is, if we are expecting 150,000 tons, and we have extracted already 20,000 tons, basically our expected life in years for that property is only 7.5 years. Our building is estimated, has an estimated useful life of 10 years, while the resource property, the wasting asset, is only 7.5 years. Therefore, we will use the lower. So that means we cannot use straight line method for the building, but rather we will use the production method. It will follow the life of the wasting asset. Therefore, we will have to compute for the depreciation rate. Building's total cost is 900,000 over 150,000. Remember, aside from straight line method, we can also use other methods. In this case, the most practicable is also production method. So 900,000 total cost of the building divided by 150,000 tons of the expected resources here. So we have 6 pesos per ton. That's our depreciation rate per unit. So therefore, in 2019, our depreciation is 20,000, the extracted unit, times 6 pesos. So we have 120,000 depreciation debit and credit accumulated depreciation building 120,000. Since we are using the output method to depreciate the building, our 2020 depreciation is now 30,000 extracted units times 6. So you have 180,000 depreciation credit accumulated depreciation building. So thank you very much for watching our videos. I hope to see you soon in more of the videos that we will be producing.